Financial spread betting continued. What you need to know. You need to learn your VWAPs from your MOOs and your OCOs. These are the types of orders you can make in spread betting. Note that you can have several orders running which are executed as trades as and when they meet your specifications. Example, share XYZ is trading at 359 to 362. 1. Market order. This is an order to buy or sell at the current price. Example, buy £10 per point at 362 is a market order. Limit order. This is an order to buy or sell at a limit price. This limit price is normally to buy slightly below or sell slightly above the current price. Example, buy £10 per point at 360 pence is a limit order that will be filled or executed if the offer price drops down to 360 pence. Stop loss order. This is an order to sell if the market falls to a certain level, a long client, or buy if the market climbs up to a certain level, short client. Stop loss orders are combined with an open position to stop out the client should the position move unfavorably. If a trader buys £10 per point at 362 pence, he or she may leave a stop loss order to sell at 340 pence to close out the position should the price fall. Stop to open order, momentum order. This is an order to buy if the market gets up to a certain level or sell if it drops down to a certain level. Unlike a stop loss order that closes out an open position, a stop to open is designed to open a position if the market is moving in certain direction. These orders are used by momentum traders whom believe the time to buy is when the market is moving up or sell when the market is moving down. For example, a new car is built, a Ford Dagenham, let's say, and this Ford Dagenham uses a certain type of battery. You want to buy shares in this battery. The more of this Ford Dagenham is sold, the more batteries will be sold. So you're going to keep on buying these batteries because you know that these Ford Dagenham cars are selling. While the Dagenham cars are selling, the batteries will sell. While the batteries sell, the share price will rise steadily. And vice versa. An order to buy £10 per point at 370 pence to open a new trade is called a buy stop. GTC, good till cancelled, an ongoing order as opposed to an ongoing trade until the client calls to cancel it. Now you can do a GTC by buying these batteries and knowing these batteries are being sold. So until you cancel it, it's like I'm good until I cancel. So you keep buying and then you realize, you ring up the battery company and say, excuse me, how many batteries did you sell this month? And they say 50. And then you ask them, how many did you sell last month? And they say 45. And you ask them, how many did you sell the previous month? And they say to you, we sold 40. So you're still good because there's 40, 45 and 50. So you are then determining next month will be 55. Vice versa, you then cancel because it's dropping down from 50 to 40, from 40 to 45 to 50, or 50 to 45 to 40. And then you know it's going to be 35. So I'm going to cancel. So it's good until you cancel. GFD, good for the day. Cancel at the end of the trading day in question. For example, you have gold. You buy gold in the morning and you think the gold price is going to fall. So in the evening, I'm going to sell. So in the morning, you buy it when the price is good. In the evening, you sell it because you know the next morning or right then and there, the price will fall. MOC, market on close, to be executed at best on the close. For example, you have this 4 Dagenham shares and every half an hour, somebody buys a 4 Dagenham. Now, every half an hour, everyone buys one. Now you know the peak of this half an hour will be 2 o'clock. So you know that after 2, they're going to go out to lunch. They're not going to buy anymore. So you then close it because that's the peak of their buying. Because then they've gone home, you see, then they're not buying anymore. So you mark it on close. Mark it on open to be executed at best on the open. So the opening price, for example, is 400. You know that it's not going to go above 400. So you open it at 400 and it goes up 405, and then you mark it on the open price. OCO, one cancels the other. Two orders are left, but the first one to be executed cancels the other. This mark it on open. You research into it. Maybe I'm wrong. OCO, one cancels the other. Two orders are left, but the first one to be executed cancels the other. Now this OCO is this. You buy shares for 400. You buy some more shares for 450. One will cancel the other, whichever one's good for you. Fill or kill. For larger orders, the broker is instructed to get a price for the whole order, and depending on the price, fill the whole order or cancel it if it's good or bad. For example, oil. If the oil price is rising, you want him to buy, so you're gonna say to him, fill it, fill it, fill it, because the oil price is rising. But if it's falling, then you fill or kill. Then the broker is instructed this way because the broker is more experienced. So he's either gonna fill the order because the oil price is rising, or he's gonna kill the order because the oil price is falling because BP has just done that. Anyway, VWAP, volume weighted average price. This is an order to be worked throughout the day to get the average price of that day. So this VWAP is, for example, is for the lazy broker. He's going to just relax all day long until about, say, 2 o'clock, when he averages out that this is the best price to buy it at because it's rising and falling, rising and falling, rising and falling, and this is the best price. So you tell him VWAP unless you want to buy or sell yourself. Setting and cancelling a stop loss, as there's illustration on there. Confirming an order, specify stop loss. More illustrations. Tracking your trades, there's an illustration there if you're familiar with the online screens. Rolling over a trade. Question: what if you want to roll a trade to the next expiry date? In order for a spread bet to be classified as a bet, it must satisfy some rules. A fixed period is one of them. A daily bet expires at the end of the day. Quarterly bets expire at the end of March, the end of June, the end of September, and the end of December. If you have an open position and the contract is nearing expiry, you can let the position expire. It will be closed at the official closing price on the expiry day, close the position before expiry, or roll over the position. Note: most spread betting companies offer a special rate to roll a position from one contract to the next. This special offer is usually done during the last few days of the contract period and allows clients to continue running the position without having to pay the dealing costs of trading in and out of the contracts manually. Example: the DAX December future contract is trading at 3600 to 3604. The lowest price is trading at 3600. The highest price is trading at 3604. The DAX March future is trading at 3610, 3614. A long roll would be to close the December contract at mid-market 3602, smack in the middle, and reopen the March contract at 3614, highest price. This roll would be cheaper than manually closing December at 3600 and manually opening at 3614, saving on the roll 2 points. What do you need to know? In a sense, the term rolling over a trade is misleading because you do have to close the original trade and pay any outstanding balance or pocket your profit. However, rolling over a trade means you save on the dealing costs in the form of a lower spread. Rollover instructions should be made at least 30 minutes before the close of the exchange on that day the bet is due to expire. For example, the London Stock Exchange normally closes at 4:30, so you do it 30 minutes before 4:30. Key points. It's a bit like, I don't usually really use eBay because most of the items I receive from eBay don't hardly work and are flimsy. However, it's like eBay. You watch it, and it goes like you say, the limit of the time is 1 minute left, and then it's 50 seconds left, and then it's 40 seconds left, and when it's about 10:09, you Say, look, I'm going to pay this much for this item. It's a bit like this, but you have to do it 30 minutes before 4:30 to the end of trade. And that was chapter 3.